Good afternoon, everyone, and welcome to our webinar 2026 to 2030, Navigating the Next 5 Years in Seniors Housing. I've been looking forward to this conversation all year long since we are entering the new era for seniors housing when baby boomers start to turn 80. We're going to see unprecedented capital flow into our industry. New entrants are going to kick the tires, some in big, flashy ways. Operations are going to keep improving across the board, and new development will eventually start to kick into gear. And this conversation is really centered around how do all of these forces, what do all these forces mean for buyers, for sellers, for lenders in the next several years? And how are they going to have to adapt their strategies to get the best returns? You can see why I've been looking forward to this conversation. I want answers to these questions. So very happy to be introducing our expert panelists in just a second. But I do want to thank today's webinar sponsor, Blueprint. Founded in 2013 with a mission to elevate healthcare real estate advisory through collaboration and data, today Blueprint is the most active advisory firm in seniors housing and skilled nursing, and a market leader within other healthcare real estate subsegments, including behavioral and medical properties. The firm also offers a dedicated capital markets practice to support clients with financing solutions, and with a proven track record of $16.5 billion in transaction volume, Blueprint's model combines broad market coverage with unrivaled analytics to deliver results. And also a big thank you to our first panelist, not this guy, but Blueprint's own Alex Floria, who really put together today's big show. So thank you so much, Alex. You've been advising on deals since 2017. Before that, you came from both the REIT and operating world, so you can bring that unique perspective to the table. So it's always a pleasure having you. Welcome.
Thanks for having me.
Next, we have Jennifer Wong, the Director of Acquisitions at AEW Capital Management, where she sources, underwrites, structures, negotiates, and manages AEW's healthcare investments. It's great to have your institutional expertise, but also to hear what deals you'll be pursuing in the coming years and also who you think you'll be competing with on those deals. So great to have you today, Jen. Welcome.
Yeah, happy to be here.
And from one active buyer to another, we are also joined by Adam Seidenberg of JDI Realty. Adam is responsible for investments and asset management at JDI's seniors housing portfolio, including both debt and equity transactions. And I'm excited for you to drop all of your secrets on JDI's growth strategy and how it might be a little different from Jen's too. So excited for that, Adam. Welcome.
Thanks. Glad to be here.
And Jerry Lang joins us from Benchmark, where he is the CFO in charge of development, asset management, capital structuring, and shaping the organization's financial strategy. Jerry came to Benchmark nearly 5 years ago after 13 years with Sunrise, and we know just how important one's quality of operator will be in all investors' growth strategies. So why not have on a quality operator on today's call? So glad you could be here, Jerry.
Thank you, Ben. Pleasure to join.
Well, we have a lot to cover in just 1 hour today, but the major topics that we want to get to are how operations will impact M&A strategies, which assets and markets to target and why, how pricing is going to change and how that impacts the types of deals that you'll pursue, and finally, when development actually works today, but also when it will or should come back into your investment strategies. And our audience can also submit questions throughout the call in the Q&A box in the Zoom window, and we'll do our best to get to them throughout the hour. And we won't be using any evaluation statistics in today's webinar, but if you do need comps, pricing metrics, cap rates, what have you, but also to see who's active in today's M&A market, be sure to check out our Levin Pro LTC platform and also our brand new property valuation tool. Any questions, the slides are available in the chat in today's webinar. So happy to answer any questions. But without further ado, on to operations. Most of the conversations in the operating world have centered around census growth in our industry. But Jen, I want to direct this first question to you. And Adam, I'd love to get your thoughts afterwards. How do you think about rent growth over the next 5 years?
Sure. The rent growth story for seniors is one that we're leading heavily into. We're seeing operators budget around 6 to 8% on average for next year. And we're seeing that we've seen that last year. We're optimistic it happens next year. We think that continues probably into 2027 as well. I would say, 5 to 6%, next year and the year after are pretty safe bets, with that tapering down to, 4, 3.5% thereafter. But Rent growth across seniors is still very, very strong. And especially in some markets where, operators have bought some occupancy in the last few years, you're seeing some of that rent growth, even higher than that, in some cases, 9 to 10%. So definitely a story where we have high conviction in. And so we're still projecting that going forward.
Adam, what about you?
I would say, similar that we have a lot of conviction in the rent growth, but I would say we're probably just a little more conservative than Jen in the approach, and that probably is a result of the type of products we're buying are just a little different, right? I would say this year we're in the 5 to 6% range across most of our properties. And when I think about underwriting, I'm probably definitely not getting to 6% as I go, start to look forward. But maybe in year one I'm getting there and then tapering down probably closer to that 4% a little faster. So I know we've seen a lot of strong rent growth historically, but some of our portfolio, we have some tertiary market stuff. We have good occupancies. We want to prioritize that still over rent growth, and the numbers are working that we don't need to push it any further than that.
Yeah, and maybe quickly, Adam and Jen and Jerry, if you want to maybe quickly give just a quick couple sentence description of the types of deals that you're pursuing in the current M&A market. Adam, you want to go first?
Sure. Yeah. So, JDI is an opportunistic investor. That's a little more value add. I would say typically like light to medium value add, nothing super heavy. Typically stay away from deals with negative NOI, though we have in certain instances changed that. I would say we kind of have two strategies. One is, more of looking at like tertiary markets and getting, what we think are a little higher cap rates approaching high single digits, maybe even double digits. But in those tertiary markets, we need good demographics too. So we still look at, incomes and affluence. So for example, we bought a property in Stevens Point, Wisconsin earlier this year. I had not heard of Stevens Point before I went to visit it. But it's an 150 unit IL ALMC. In that, the median household income for adult children is 100,000 in the 5 and 10 mile radius. And there's good density too, of about 50,000 people in that 5 mile radius. So tertiary or maybe even secondary, I don't know what you consider it. But that's the worst for us. So we're picky. And then I would say, we're very sensitive to price per unit as well. So, in the past 12 months, JD has acquired 10 properties and 1,200 units. 12 months ago, we had none. So we've grown a lot. And of those 10 properties, none have been over 200,000 a unit on purchase price. With CapEx, maybe we're a little bit above that on some deals if we have, a heavy CapEx strategy, renovation, something like that. But in general, we're around, we like to be very sensitive on price per unit, not only discount to replacement costs, but really discount to, potentially prior basis, prior loan balance, things like that.
And Jen, what about AEW?
Yeah, we're kind of on the opposite of that spectrum. But we do have, several different buckets of capital, primarily kind of core and opportunistic. But we're looking for newer vintage, top 25 markets, preferably over 100 units, some kind of continuum. Full continuum is best, but we'll take AL memory care as well. Proven operator, and, stabilized on the core side. On the opportunistic side, really assets with core attributes. But we're willing to take some lease up risk. And certainly some of those deals have some capital stack issues as well. So, willing to take on some risk, but, still having some physical core attributes. I did want to clarify, although we're seeing, some 6 to 8% rent growth, we are not underwriting that. We're typically more around 4 to 5%. So similar to Adam.
And Jerry, just quickly, what's Benchmark largely pursuing? You're muted.
We are right in between Adam and Jen, so I guess we are the mama bear, so to speak. So on one hand, we certainly have recapitalizations of our own existing products as we trade out successful performance and bring in new partners. And so, we lean in and reinvest as a joint venture, minority partner into our own things, certainly at basically core plus levels. And we believe in really the long-term macros behind our buildings and the industry. But then also on a kind of acquisition basis, we take a spot right in between where, we've done distressed turnarounds and have found great success in that. But it's a lot of brain damage, right? And you do take on a meaningful amount of risk. More recently, where we've specialized is taking kind of near stable, right, or potentially some semi-stable with a little bit of optimization left, right, and really making a bet on our operational prowess to bend the curve and squeeze out the incremental juice.
Well, Alex, you've done a fantastic job of building today's panel, covering all corners of the M&A market. So I know you had some questions for our panelists as well. So you want to
Yeah.
take it away?
Sorry, I'm pretty sure if Jerry's the middle bear and we got three bears, that makes me Goldilocks, which is not a thought I'd had before today, and it's kind of throwing me off a little bit. So, I mean, I think that the follow-up I'd have is you hear so much about the silver tsunami. You hear so much about population growth and the lack of supply, new supply in the near term. It'll pick up, but it'll be years before you see a meaningful change. I mean, how do you think about the income qualification part of that? How do you think about what does that actually get you? And I think let's split that into two sub questions. Like Jerry, we've looked at some assets with you that are, New England, but let's generally call them very non-Boston. You're getting 12, 13, 14, 15,000 a month in rent. You look at home value, you look at median incomes, they don't support that, but everything's full. Rate grows every year. How do you think about that? And how does that carry forward if theoretically there's even more people that need it and there isn't new supply?
Great question, Alex. I just want to caveat to say, I think, the United States is very large, right? And the different regions and the different, submarkets and states, can behave quite differently. So I can really truly only speak to where our footprint is in between New England and down to mid-Atlantic. To your point and your question of just now, I think what we're seeing and realizing in the New England market is that post-COVID, home values have risen so dramatically that they've like functionally doubled over the course of that, couple year period and accelerated like 10 years of housing inflation. So kind of the net equity wealth in this overall area for, those lucky enough to be homeowners and, to reach that age where they're coming into our buildings is far more substantial than it had ever expected or seen previously. And so, I think ultimately that the pressure valve or the pressure point of particularly in higher acuity AL memory care and certainly specialized services where you kind of don't have too many other options. Ultimately, I think the prices are fully supported by what is functionally a decision regarding wealth and wealth transfer, right? And the degree to which you're able to pass inheritance or not. But I think the wealth levels are fundamentally there with, just how dramatically home equity has risen.
Got it. So I think
Adam, how are you approaching affordability when you're looking at the kind of types of communities in those tertiary markets like Stevens Point?
Yeah, I mean, I would say our mindset's pretty similar. I mean, obviously, maybe not like doubling home values, but while we do have some tertiary markets, we also have a lot of, or some properties in and nice, good core markets too that are just more of, a value add play. And there's, maybe a little bit of distress. I wouldn't say like a total distress turnaround, places like Houston, Atlanta, and things like that, right? There's been a lot of just increase of home values in all those places. But yeah, we're really sensitive to demos no matter what we're looking at, right? I think I turn down, opportunities the most that Alex or people have on the market because of demographics. And I think we're really concerned about what happens 3, 4 years from now when labor still continues to grow. Maybe it's at a more predictable or stabilized rate. But you can't push maybe the rents go from 8 to 4%, right? And they just at some point you just get to a huge number and it needs to be affordable. So that's why we're really thoughtful on that demographics, as well. And I would say that's probably the thing I struggle with the most when I'm looking at new deals is are the demographics kind of up to our standards? And most of the time, like they're just really not. So I don't know. I guess at some point in time that changes, but there's obviously a lot out there and you can make it work, but it can be a challenge.
Yeah, and Jen, how are you approaching the labor outlook from a perspective of maybe what markets you're targeting, but also kind of projecting out future returns for where labor expenses could be in the future?
Yeah, we've seen across the board labor really stabilize, especially post-COVID. Really, in the last year, it's just gotten a lot better. I think it's so market specific though. Certain markets are really, really tough, just based on the demographics and just the local economy as well.
Are
And so
there any off the top of your head?
San Jose is historically has been really tough. Certain very high income areas are tough, especially if, for example, like Boulder is also tough. It's expensive. It's, harder to get to. And so, it's really market specific. And so you need a strong local team to make that work, and be thoughtful about how to attract good talent and to keep them, giving them good benefits, good transportation options, having a good culture. All of that really matters. And so we have to be really thoughtful and careful when we're underwriting new deals. Getting the local color is super important. But I would say as a whole, our portfolio, has really stabilized on the labor front. And going forward, we typically underwrite 3 to 4% growth. I think at this point in the economy, it seems like labor availability may be getting better, despite some immigration issues that our country is having. But it is certainly stabilized from a few years ago for sure.
Yeah, and we see the same thing, and I think one point that Jen made, which is really important, is like the operator is so important, right? Jerry and all of, the great operators out there when you're thinking about labor inflation is if you have a good operator and a good on-site team, I mean, that's just going to prevent so much, wage inflation because people will stay, there'll be less turnover. There's just less of a fire drill for lack of a better term. So I feel like when we're thinking about labor, we also think a lot about, our manager, our operator, our partner too, because I think that's a key component in kind of managing, that and keeping it stable over, the next 3 to 5 years.
And Jen and Adam, you mentioned the getting more flexible with offering good transportation or something like childcare to help with labor. Is that something that's coming from JDI from AEW, or are you trying to partner with operators that are already taking those kinds of programs into consideration?
A lot of our operators have those programs in place. We're certainly very supportive on the capital side, but some of our operators are just really innovative in terms of trying to create the best working environment. So we're certainly supportive of any ideas that they have, and and supporting them on the capital side too.
Got it. And then we have a couple of audience questions. Jerry, if you could quickly take this. What about care fee increases for 2026? How are you looking at that?
Um, Ours are relatively modest. I'd say probably low single digits for this year, going to next year. But part of that was driven by we were much more aggressive in driving care rate growth in the previous 3 to 4 years. I'll just say that I think pricing on care is sensitive and important. And when groups underprice care, you're just functionally creating shadow discounting, right? And so, we've thought that to be quite important and, did some really large resets back in like 21 and 22. And then further as labor was rising, kind of did even more so on the upper end in 22 and 23. And so at this point, we're kind of top of the market wherever we are in terms of labor pricing, which has its pluses and benefits to customers. But I think it's necessary, and so I think we're at a good equilibrium level, and so it's just inflationary from this year to next.
Yeah. And your planned care fee increases in 2026, but also in the several years from now, let's perhaps guess that the average resident is going to be more higher acuity when they move in. Do you see that changing your strategy of catering to more lower acuity residents that maybe you can limit your labor pool, or do you want to cater to the higher acuity residents and potentially make up some of that revenue on the fee side?
It's a great question, Ben. I think what we've ended up finding is that when you properly price for care, you dissuade people who come in and who don't necessarily truly fully need it, right? And then you put a greater emphasis on the proper assessment, right? So our communities are actually very active, very low acuity on average, probably something like 40% are at level 1 or below. But we retain the ability to care for them as they age in place. And so that really creates some value proposition that they don't have to move. And so by being able to, take in level 4, 5, 6 plus of care and, 2-person transfers and such, we kind of create a safe environment for aging.
All right. Thanks for, sorry, I'm spraying some of these follow-ons on you guys, and I'm loving what I'm getting. Alex, I think we have to go to the last question in the operating section. Time is already flying by, but what questions, I think there could be a lot of new entrants on this call right now and new entrants peeking into the seniors housing space. So what are the questions that you're getting from new entrants on the capital side? What are they asking about operations? And then what are you wishing that they're asking about operations?
So, it's kind of funny because I feel like in terms of questions I get asked, what operators do you know that could put in 10% equity and can deliver us new full continuum of care deals, ideally as a recap for and kind of that high teens, but we might go into the mid-teens levered returns range. In terms of questions, I'd say that's the number one question I get. I think what a lot of people talk about and is very interesting is I feel like there's more and more interesting knowledge coming in from multifamily and hospitality, and people talk about dynamic pricing and just much more sophisticated demographic screening and algorithms. And it feels like there's a lot of very interesting ideas on the revenue side. And admittedly, I think most of senior living has a long way to go to catch up with multi hotels. Like there's just kind of like worlds apart from my perspective. We don't talk a lot about the expense side. And I think that's something where, as the investor, it's not your job to micromanage. Like let Jerry do his job, let Benchmark do theirs. But I do think that's a place where people don't necessarily understand how deeply intertwined that piece of it is with everything else, and especially the labor component. That's the one thing that I think it shouldn't scare anybody off, and that's not the intent of it. But I think the more you understand that and you have the awareness and the curiosity on the front end, the less likely you get in that, you're halfway through a transaction and you're like, oh my God, this is everything that happens in a senior living community. I never really explicitly thought about that. I think that's kind of been a challenge with new entrants before. The thesis sounds great, the demographics sound great, and then you tour a memory care wing and it's eye-opening. That would be my biggest commentary, and Jerry shaking his head makes me feel like I'm not crazy, so thank you for that.
Ben, we at JDI we invest in all asset classes, all asset types. There's probably something we haven't. There probably isn't anything we haven't touched. I think, I'm the only one who really focuses on senior housing for us, and I think the biggest question I get internally from other folks who are focused more on apartments, manufactured housing, office, retail, whatever, is like what happens in a downturn? Like how is this really expensive product? What is it? What happens in an economic crisis? I think is the biggest question we get or I get internally. And I don't know what the right answer for that is. I think like anything, there are risks, right? And in a downturn, a lot of things are going to be hit hard. But I think kind of how I rationalize it is just that because there's such a lack of supply coming and there's so much demand and so many people are aging that even if there is a downturn and that you have a lot more people who all of a sudden now can't afford seniors, senior housing, I should say, I think that, because there's gonna be so little optionality out there. I think the stuff that's, performing and has a good reputation, and looks nice, I think we'll ultimately be able to survive it. But I think that is the biggest question I get internally.
Hmm. Interesting. Well, moving on to the M&A market, Jen, I want to direct this first question to you. How are you thinking about the deal inventory pool right now when PE buys, you know, comes around again, what REITs buy generally doesn't? And with the REITs so active in the last few years, and then with little new supply, how does that affect the pool of tradable assets right now?
Yeah, it makes my job harder for sure. We certainly think about that. It's REITs are very active. They're very aggressive. It's super competitive out there in the capital markets. And yeah, once a REIT acquires an asset, you probably don't see it for a pretty long time. So the inventory of seniors, it's a small sandbox compared to any other sector in real estate, such as multi or industrial. But there is a lot of good product out there. I think private equity still holds a lot, and that's where you really have to get creative around structure with an operator, recaps with them, or generally how we approach the space. And certain operators are choosy about who they want to work with. They might not want to work with a REIT, and so being flexible in structure, being friendly capital, has been super super advantageous for us. But yeah, certainly I think about how that sandbox is shrinking as the REITs continue to be very active into next year.
And the number of kids coming into that sandbox is just going to keep growing as well.
Correct.
So that that's when things are going to get frothy. And Alex, regarding the deal inventory pool, how do you see that affecting M&A volume in the next few years?
I mean, I think there's been a lot done. I think it's not quite as much as it sounds like. So, the Welltower announcing 23 billion in transactions, everybody referenced, I referenced. That's still 14 of acquisitions, 3 of 9 of dispositions. The acquisitions is 2/3 in the UK.
Hmm.
But look, they're still going to probably do 8 billion of US senior housing, and you'll probably have Ventas do 3. There's been more volume recently. I think the biggest challenge is there's going to be the years that you really didn't have development, you're going to have that gap for the years that those buildings should be stabilizing now and should start kind of trading. You're just going to miss that kind of whole cohort because of the more depressed development environment. But
Hmm.
there's still a lot, surprisingly, that people have held through COVID. Performance has come back, capital markets have come back. People had to triage the tougher assets, so they're holding on to the high quality ones because that's what saves the fund. So there's still more of those than I would have thought, or I think most of us would have thought that'll come to market. And then I think there were a lot that were bought in that kind of 2021, 22. We have a vaccine. It's not the end of the world, but interest rates are still zero period. And those are going to start coming back around now they kind of naturally mature and the market's recovered enough that folks have to take a realistic look at that basis and leverage point.
Mhm. Well, the cap rates that they were able to acquire a lot of those facilities for were still, I mean, it's all relative, but significantly lower than they still are today as well.
Yeah.
And so I want to move on to a cap rates question to Jerry and Adam. How much can Class A cap rates compress without treasuries compressing as well? We've seen a lot of cap rate compression in 2025, and it's been accelerating ever since the summer in the Class A kind of part of the market. How much more can you see in 2026 as far as compression in, let's just say, rates stay flat?
Go ahead,
Jerry, you
Adam.
want to take that first?
Oh, sure. Actually think Jennifer might be better suited for it. I guess my perspective on it is it will just it I think it really begins depending on competitive tension, right? So I think location, sizing of deal or portfolio size, kind of like how well it fits into strike zones. Like the more groups where something fits into their strike zone, like the sheer volume of interest and activity is really where you get the kind of incremental compression as, some group that has been bridesmaid for too many times, like just gets sick of losing, right? And says, we got to win something. That's what we'll have to do. So, I mean, on all honesty, no different than like what happened in the residential markets, right? A few years ago, specifically up here in Boston. So, but I'm probably not the best person for this.
Then and
Yeah,
Adam, do you want to take it?
I mean, I could be quick and then pass it over to Jen. I mean, look, cap rates are compressing. I feel that in the non-Class A world that I live in, very much so. I think that, there's more demand, there's more people coming to the market, and that ultimately pushes cap rates down. I also think from my perspective, like there has to be a spread versus Class A multifamily and, Class A senior housing. At least I would think so. Maybe that'll change. I don't know. There's been a lot of crazy things that happened over the past few years, but in my mind, there should be a spread there. And so I'd like to think there's, I don't know, a ceiling or a floor, however you want to look at it. But I don't know, some of the, the things I've heard from Alex or some, other people in this space is that, cap rates have started to approach what Class A multifamily trades at. But I think as that starts to get closer, and now we're starting to see multifamily actually kind of start to trade again after a pretty slow couple of years, I think maybe some of the capital that's looking for seniors might go back to multi if it's going to be a similar return profile and maybe not the same risk profile.
yeah. I would add that what we've seen trade the last year, it's been the have and the have-nots. Your newer full continuum deals with 130 to 150 units, you're getting 10 to 12 buyers in the mix, and those cap rates have compressed 50 to 100 basis points. The smaller unit count deals that are older, AL memory care only, perhaps a secondary or tertiary market, those cap rates are still where they were a year ago,
Mhm.
what we've seen. And so you're seeing buyers show up for that buy box that a lot of our peers have, and fewer buyers show up for the ones that are not in favor for their buy box. So it's kind of very bifurcated, I would say, but we're certainly seeing cap rates compress for deals that have higher demand, which is just totally natural. Um, and I agree with Adam that there should be a spread to multifamily, but senior housing cap rates are also super nuanced. Is it trailing? Is it forward? Even T3 versus T12 could have a big spread. And so, if you're looking at stabilized cap rates in seniors, we're still seeing, 100, 150 basis points spread to multifamily for similar like kind product. I think that spread is still there. The fundamentals for senior housing is super strong. And it's ultimately a risk on asset class, right? You're getting paid to take on risk. I think as long as that spread is still there, I don't think things are too frothy quite yet.
That is a
So,
perfect segue into Alex. I
yeah,
think you had a question.
I mean, and I think we've touched on parts of it, but maybe let's just reframe a little. So how do you measure frothiness? because I think there's a good chance that as this market improves, so does multi. If multi goes back to being a 3.5 cap for something in new and shiny in Boston, is a 5 cap for full continuum majority IL. That, like, how do you even measure that? What's the right benchmark, especially when you went through a really tough stretch in COVID. You went through a really euphoric stretch where everything makes sense when your interest rate's zero and you're arguing about whether the floor is 0 bips, 25 bips, or 50. And then you go to a world where, well, the treasury is 420. Like your high fives for an agency execution. Like, how do you even measure frothiness?
JDI's perspective on that, I mean, isn't necessarily related to like what deals are trading for, but I think that when development comes back in a real way, that's when we think probably the frothiness is hit, and that's probably a time when we'll be, I would assume, less active than we are this year and next year, and hopefully the year after that too. But I think when we think about frothiness in the market, we look a lot to development pipeline and whether people are actually building in a serious way.
Jen,
Yeah,
what about you?
it's a multifaceted answer. But you're looking at cap rates, you're looking at price per unit, total return. And I think total return is still very healthy compared to multifamily. And so again, this is a risk on asset class. You're taking on risk and getting compensated to invest in a niche asset class that has super strong fundamentals, but has a very complex operating component. And I think, I agree with Adam that once it becomes less attractive to acquire compared to development, it's probably where you see that tipping point to get back into development. But yeah, price per unit is usually a pretty good measure, for frothiness. But again, that's also super nuanced. If you have a higher acuity type community and your care fees are, a big part of your value, you're seeing, some of those trades that are, pretty much at replacement cost today. So it's a very nuanced question. I think it's just such a different animal from multifamily that you kind of have to look at everything.
Is there any worry at all that cap rates could go too low in 2026, let's say?
It totally depends on all your assumptions that you're inputting. If you're
Yeah.
still seeing that rate growth, if you're seeing strong occupancies, it's a fair bet that your stabilized cap rate will be higher than what you're achieving for multifamily. But that's one of the beauties of senior housing. It's like you have a million inputs to work.
Yeah.
And so I think cap rate is a very nuanced question here.
Yeah. I agree with Jennifer. And I think this convo really does kind of circles back to the beginning question about rate growth, right? Which is fundamentally like, I think seniors and why it's so popular now has one of the few, real estate food groups that has the ability to fundamentally alter the trajectory of future cash flows, right? Like NOI growth can be outsized in this space, in a way that it's really hard to do so in many of those others, right? Like with multi, you're kind of price perfection, and it's functionally a macro econ bet to, rent growth in areas that might already be tapped out, right? Whereas like for seniors, like, if you adjust assumptions and depends on how hard you believe in, some of the macro forecasts, right? Of the silver tsunami and all the things we're talking about of no supply, like, well, what happens? What functionally happens, right? Is it too extreme to believe that you'll get 10% NOI growth, going forward, annually? I don't know,
That
right?
I
Like
mean
that.
that's a great point. Does that instill any fear at all that you could have some quote dumb money come into the space and make a lot of those assumptions and it just doesn't pan out for them?
I mean, I think, re real estate always moves in cycles, right? So yes, eventually that happens, right? Over the course of time, it will just continue, escalating, and eventually that is late cycle, right? But I personally don't feel like we're there.
Alex, we got an audience question. Are you seeing many, if any, true cap rate deals, or is deal value often based on price per unit or some other basis?
Um, I think at the end of the day, everything does just come back to total return. Like cap rate is a very easy, comparable, seemingly straightforward way to talk about it. I think kind of to Jen's point, there are a lot of cap rate deals. We talk a lot about in terms of cap rates, but is that a year one? Is that a fully stabilized? I feel like usually we don't talk a lot about per unit unless it's so high that there's really no comps to support it, or it's for some reason so low that you can credibly make the argument that it's hard to get worse. Um, I would say those are checks. Most of it we talk about cap rate, but we talk about it as kind of a progression, right? So we look to a T3 or a T2 or one as kind of like, what's your floor? Do you have negative leverage going in? Can you cover debt? Do you have kind of that margin or some margin of safety? And then is year one palatable? Is there sufficient growth, year one to year two to say, hey, it's not just palatable, it's attractive. So I think we're having the conversation of like, hey, you're starting here, here's your historical. The historical doesn't necessarily tell the entire story in a circumstance where you're still getting 6, 7, 8% rent growth. If you're getting that and you're getting 3 to 4% wage growth, you're you're going to have meaningful margin and cash flow expansion. So we don't talk about a cap rate. We talk about a sequence of cap rates and the story that they tell.
Thank you for that. Jen, how are you thinking about partnership structures these days? When would you consider third-party management versus a JV? And how do you feel about non-operator GPs or even co-GPs?
Yeah, we typically prefer a JV structure. What we're looking for is alignment from the operator. And it's the splits don't really matter at the end of the day as long as there's meaningful skin in the game. And it's great when a principal at the operator personally invests as well. But really, what we're looking for is just alignment with us. And so that's what we prefer. We've done third-party management deals as well. It just kind of depends on the deal itself. I think for long-term conviction type assets, we certainly prefer a JV. And if it's a situation where we're going to try out an operator for a year or two, that's probably where we would go with third-party management. But I would say like 99% of our portfolio is done in a JV. In terms of co-GP funds or we don't mind them as long as there is that alignment there. During a diligence process, we'll dig into what percentage is actually being invested by that GP fund versus the principals of the operator. And certainly we'll want more principal investment. But we're open to that structure.
Got it. And Alex, how are you seeing partnership structures from the brokerage perspective?
So, I mean, I think as the market heats up, there's more people looking to enter with different ideas. And I think a lot of times for competitive deals, there can be more pressure on the incoming, when I say buyer, I mean LP, to be flexible as part of winning the deal. So we've seen kind of a couple of folks look at programmatic co-GP funds. Had one conversation was, oh, that's interesting. Okay. And then you'll go to a conference and have three more about it. And it's okay. I understand kind of the financial pitch of it. I guess my question is, for Jen or for me as the broker, like, okay, you let your partner scale. That's great. Do I now have another counterparty? What you're not just putting your money in, right? You want to say, what does that mean? What rights do you want? Is this now a three-way PSA negotiate? Like, how does all of that work? I think there's a place for everything. I think the more kind of creativity you see probably does somewhat correlate with the frothiness. Um, but I think you can ask for a lot more stuff. You might still get told no, but you're not going to get laughed out of the room. Like in 2004, you're getting laughed out of the room. There's no, I tell you what it's going to be. You don't propose creative ideas. Um, but I think a lot of it also just depends. Like, what do you actually add? Like, if you're the co-GP on a stable deal with non-recourse debt, why? If you're the co-GP on a development deal and you can help support a loan, even if it's non-recourse, if you can help provide liquidity or pursuit capital, that's a lot more interesting. Same kind of deal with like the non-operator GPs. It's, are you really good and really specialized or really knowledgeable? Or is it just, hey, what if I take the promote and I get a management fee and then we just do third-party management under it? So there's a couple of different versions. I think from a broker standpoint, you're just trying to be realistic and practical about, does this help the deal? Does this hurt the deal? Do I understand how this would work? If the seller asked me, hey, what is this? Did you know they were going to do this? Do we have an intelligent answer? And did we factor that into the advice that we gave our client, especially because a lot of these are pretty competitive processes.
Hmm.
So
Yeah,
let's see how many people I pissed off with that one.
I was gonna say I think for the JDI is typically pretty flexible on structure. I'd say that 90% of our deals are JVs with our operators. On the non-operator GPs, I think there just has to be a value add. To Alex's point, and there's a lot of ways to do that. You can be really sophisticated and knowledgeable in the space. You can also be a great deal finder, a deal hunter, and get deals that not everybody's seen, right? Like that's true value add too. I think when it's just, looking at marketed deals, that's harder, right? Um, but if there's a real value add there, I think there's a path for that. But I don't know. I think the LPs in the space are getting more sophisticated too, right? So as that seems to happen, granted not for the new entrants, but for other people, there's a lot more people who are looking at it who are necessarily not, part of that GP world.
Yeah. Hmm. Well, one last question in this M&A section, and it's going to be on new entrants. Jerry, I'll throw it to you first. How do you think the new entrants will disrupt the M&A market? Where do you think they're going to come from? From what world? And also, what do you think they need to know before entering our industry?
I mean, I feel like we're already seeing a whole bunch of them, right? So in certain cases, you've got investment leaders from, larger institutions who've traded seats, right? And that are now heading, the either new groups altogether or like the seniors practice of a major real estate group, right? They're very large, very, very large LP players who, I've seen in other spaces are like coming in. Like this last, fall Nick was very busy with lots of conversations such as, will you be my friend? And so, I think disruption wise, it will be a little while for them to dip their toes in and, participate in a bunch of processes that Alex and others run in order to get more accustomed and, you know, build up the conviction to go try and win, right? Because it's just going to get really competitive as we talked about. And if you want to win, everyone's going to be getting a little more uncomfortable, right? And having to have more conviction and slightly higher medium-term assumptions. So, I think it was probably a little while before some of those new groups really cause major disruptions. Although, honestly, I think we've seen a little bit of it this year. There was a major kind of Class A three-pack of newish developed assets where, a new entrant, jumped the second round bid, right? And took it down, right? So, there's stuff like that already happening.
Yeah, and I would add too, I think like patience is really important in our industry because when you look at even like things just take time, right? Like, and it's not for the faint of heart because like we bought a turnaround deal 2 months ago now, and there's been some occupancy moving backwards a little bit. Financials are moving the right way, but if it's not capitalized correctly, a lot of these deals could get into trouble fast. And I think the patience even starts before the deal is closed. Like to buy a senior living property just takes so much time. Like you can close on a multi-deal and industrial deal in like 30 or 60 days, if not even faster than that. Like you can move really fast. And seniors, like 4 to 6 months is great, right? Like, so it's just everything is slower. It starts on the acquisitions on the investment front, but really runs through, kind of you exit your position as well. It's much, much slower.
It give them a little more time to be really sure that they want to enter the market. Interesting. Well,
Yeah.
I think what could add to some patience in the market, generally speaking, is the still current lack of new development. So let's move on to that section. Alex, it seems like there's a flood coming, but just has not hit us
Yeah.
yet. When do you think that flood of new development will hit? Could it be back half of next year, perhaps, on the early front?
I think it might even be middle.
Mhm.
I'm going to pass the buck a
What's gonna
little.
cause that to
Well, so I'm
change?
going to pass the buck a little bit, Ben. You. So I think there's two kind of big holdups, right? One is there's this perception that development doesn't work, that the return still isn't kind of proven out at the cost to develop today. I think that's what's holding a lot of folks back. And that has been historically true, like historically the last year and a half, too. We're going in the right direction. I think the other part of it is for some of these high-end markets, it's very expensive to build, and there just aren't enough sold comps to support sometimes even the development cost, much less what the exit looks like. We're trending in that direction. I think there's a lot of these circumstances that, look, price per unit's an output, right? It's NOI and cap rate. NOI is going to be not entirely, but largely driven by rate. There's no reason that you can't extrapolate some of these and get to a number that works, but you don't want to build at 700 a unit for something that you're extrapolating. As we,
The resonant rates can get a little scary sometimes to make those pencil.
but I mean, like for the type of markets that people in some of these circumstances, like, yes, that's the whole point. That's the entire, if you're going to say, I only look at the top 5% of, major zip codes, top 5% of zip codes in major MSAs, then yeah, 10 grand for IL is just, maybe that's just what that is. But I think it's having the proof of concept. It's having more trades. It's having just enough to look at it and go, it makes more than intuitive sense. I can prove to somebody why I think I can exit this asset for 600K a unit in a state that hasn't seen that before. So the sooner we get kind of more of that transparency, the sooner we get more of those printed, because they're happening.
Mhm.
I think that just makes it easier and easier for folks. And I think there's a strong underlying draw to, well, we want to build it because we want to have product that we see as durable and just like we want it to be right, perfect, ours, whatever. It's okay if it costs more because there's no studios. The units are the right size, the amenities are right. I think there's a lot of interest in that, especially from some of the new entrants that are looking to kind of modernize or hospitality eyes kind of the industry. So I think you'll see it and soon.
Yeah. Well, Jerry, you have some active developments right now. What's your secret in getting those to break ground and open successfully?
Yeah, for us, we've been I would just say luck. We've been very lucky, been very fortunate. We were able to both either A, keep alive some of the projects from a pre-COVID basis, ones that we spent years entitling, years getting permits for. And in other cases, we've been able to acquire kind of the work of some others who basically did the same and then were unable to kind of bring it to completion. right? And so I think the real the real long gestation cycle on development, particularly in high barrier to entry markets, comes from sourcing, right? That like it's not ready to go. Oftentimes these places take a year to 2 years or more for just getting the entitlement approvals, and then perhaps another year to year and a half for kind of all of the ancillary permits and approvals. And so, there's a lot of pursuit costs. It's millions upon millions of dollars of pursuit costs, over and above just like over and above closing on the land. And so, we've been able to get some of this stuff off because we never took the irons out of the fire, right? And we were able to kind of plant these saplings a lot earlier. And so, yeah, I think, as we talked earlier today, growth percentage and growth rates are great, like recovery is great, but in many cases it's off a pretty low basis, low levels, whether it's occupancy or even just, or NOI. And so to Alex's point, as over these next, year or two, as like the absolute levels of performance continue to improve and get to, the high enough NOI per unit to really begin kind of proving out and justifying to the overall marketplace that like, 7 years from now you can get to blank, right? Like I think that's going to be what's required because, we can see on public data about like, oh, we've grown 20% year over year or whatever, right? But what they don't tell you is where it really came from to where it's going to. And those levels perhaps are just not sufficient to justify, new builds.
Yeah. Well, amazingly, we have time for one more question. I want to make sure it hits each of you. So I figured we should wrap up with kind of a quick fire round. No more than, I guess, 30 seconds to each answer. But what is a major change in the industry that you are bracing for? It can be something in the capital markets, labor, technology, any kind of regulation. What's something that's you think not obvious that is coming and influences your growth philosophy? Jen, I'll start with you.
That's a tough question.
And you only have 30 seconds.
Yeah, I think getting seniors added to the NCREIF benchmark has been a big change, and I think senior housing becomes less of a niche asset class and one that is truly multifamily adjacent in some ways. And as more core funds start to add senior housing, to their allocation, we start to see kind of a maturation of the industry. Certainly it'll get more competitive, but I also think, having seniors in the benchmark is a major change that, we'll see more of the consequences of that.
Good answer. Jerry, what about you?
I'm interested to see how the market further bifurcates as all assets age every year, right? And so to see which ones have continued to lean in and invest on the CapEx and which ones don't, and to begin, because I'm curious as to when we are going to see functional obsolescence from some of the older assets. I think we're seeing little bits of it, but not as much as I would have expected. And so curious to see how that plays out.
Yeah. Well, that'll be the subject of a white paper that Steve Monroe has written that will be coming out this week on the future of seniors housing. So that's a great promo for it, Jerry. Thank you. Adam, what about you?
I think
Are you going to be buying some of those older assets and turning them into beautiful new ones?
We really haven't done that quite yet. We've taken a run and look at some of them, but just hasn't worked out. I think something that we think about a lot is the middle market, and I think it's something that the industry is not necessarily I'm gonna say like worried about, but it isn't necessarily like taken into account for. And I think as costs continue to rise, we have to try to fix costs in our industry. Like there's gonna be people who just can't afford the nice stuff, and even the maybe like the more B plusy stuff that I look at a lot, like that's expensive too. So I just think that there's this middle market, and I don't know how you deal with it. I think like if you have a low enough basis, you certainly can try to help with it. But It's something that's going to be coming in a large way because all the boomers are coming and a lot of them have money and are wealthy and a lot of them aren't. So there's just going to be a lot of demand for that too.
Top of mind for us here as well. So love that answer. Alex, you want to take us home?
Sure. So personally, I don't think we're done seeing disruption in the labor market and just kind of the way that senior housing, not necessarily licensing, but training accreditation works. Like you had this stretch, and I think especially pre-COVID and pre-minimum wage jumps where, the people that are taking care of your mom, your grandma, well, they do it because they love it, they care, they are altruistic. Like they make $8 an hour. You can't live off of that. Like there were some of these, and you think of some of the places in the Southeast where it's like, well, how did you used to make money at, 4,000, 4,500 in RevPORs? Because the wages were not livable. I think we've bridged a lot of that gap. You've had a lot of that jump. I think the next kind of piece of it is, I think as the industry evolves, you'll have more training, you'll have more specialization. Like think about a doctor's office, think about a hospital, right? You have the different levels of training, you have the different levels of credentialing, specialization. You have a relatively rigid system. And here it's, does the state have a staffing minimum? Do you need an LPN? Can you get away with, like, what kind of nurse can you get away with? I think that's going to have to continue to evolve. I think technology plays a role in that, but it still feels surprisingly squishy and kind of operator specific to me. I think there's more figuring out to do there. I don't know what exactly that means, but I like the mix between kind of hospitality and care that we provide is really nothing like it. And I think that dynamic's gonna continue to evolve, especially as everybody gets more sophisticated and there's more data and technology and labor pressure and everything. So I don't know where it ends, but I've kind of got that in the back of my head.
Yeah. I mean, that is kind of the key question going forward also for this industry. So that's a great one to end on. I want to thank Blueprint for sponsoring today's webinar. And Alex, Adam, Jerry, Jen, thank you so much for joining me today. I appreciate all the time spent, preparing for this, and of course the hour today. I thought it was a great conversation, a lot of good topics covered, and really excited to see how each of you grow in the next several years. I think it's worth revisiting this conversation in 2028 perhaps, and see how everything's going. So if you could all pencil that in, that'd be great. And in the meantime, we'll be enjoying watching it. So thank you all so much. Great conversation, and hope to see you all soon.